Hi, Steve Van Metre here. Welcome to Macro Wednesday, where we try to make sense of markets. No, they don't really make any sense. Talk macro, and more importantly, answer your questions. Let's look at the macro events of the day. It started out with stock prices rising and overnight trading past yesterday's closing value. How crazy is that? So stocks were on a tear in early trading. And bond prices, well, they were actually up in early trading before they took a little dip. But why were markets up? Well, they were up on a report from Gilead about something I can't say, I don't know how you say, whatever it is, that we might kind of have a cure, but we don't. Now, China's already tested this stuff, and they concluded, well, it really doesn't work. But nevertheless, the market got excited about this. And let me tell you, I've done some homework on the coronavirus from a macro perspective. Now, there are 7 different strains of corona-type viruses that humans can get. Take a guess about how many of those we have a cure for. Right, none. Guess how many we have a vaccine for? Correct again, none. And that's a problem, because today when we heard from Fed Chair Jerome Powell, well, there's some risks that the economy is not going to rebound that quickly. Yet the stock market clearly thinks that the coronavirus is a done deal. The reality is, at some point, we're all probably going to get this thing. And so that kind of makes me think about the coronavirus from a macro perspective and what we did, why we did it, and what that might actually mean. The first thing, we could have just done nothing. Said, hey, everyone, you're going to get this thing, and survival of fittest, good luck to you. And it probably would have overwhelmed the hospital system, as we've seen, but we could have done that, but we chose not to. Instead, we said, hey, let's quarantine, shut down the economy. And what is the risk of doing that? Deflation, massive amounts of deflation. Now, what is the risk of just keeping the economy open? Well, people would die, so we'd have less consumers, and that would eventually turn into less growth and probably some people being panicky, probably turn into deflation. So we have option 1, deflationary. Option 2, really deflationary, is that's just, let's quarantine the economy, let the thing collapse, and then we'll go forward. But we didn't do those either. We went with door number 3, which is pump this thing full of more liquidity than we've ever seen in our lifetime. And yet, what is the outcome of pumping liquidity into the economy? Is it inflationary or deflationary? It's deflationary, and that's the beauty of it. All 3 outcomes, we get the same result. The only thing we don't get from the last option of pumping all this liquidity is we don't get the instant effects of deflation. We get a delayed effect. I think of deflation really like getting sick, right? All of a sudden, boom, you get sick and you're down for the count. Now, if you had a choice of how sick you could be, would you prefer, hey, you're going to be sick as a dog for 3 days, you're going to wish your life was ending, but 3 days later, guaranteed, you'll be back on your feet and up and running? Or would you rather have a month of being in and out of being sick, maybe some days worse than others, with a small chance at the end of the month that, well, you weren't really sick at all and you're okay now, or you're so horrendously sick that had you taken the 3-day choice, it would have looked a lot better? Well, a lot of people say, let's just get this over with and be done with it. And that's what deflation does. What monetary policy tries to do is say, hey, look, let's not get sick. Let's pump ourselves full of drugs and hope this really isn't a cold. And then later on, when we find out, whoopsie, pumping ourselves full of monetary drugs is actually deflationary and it doesn't actually work, we'll be in worse shape. That's what we did. Or at least that's the path that we're on. And I can tell you how the outcome will be. I can't obviously tell you that day will be today, but that is what will happen. So GDP, the preliminary GDP report came out today and went negative, and that surprised some people. But if you're a macro investor, didn't surprise you at all. Let me show you how you could know that ahead of time is because GDP follows, you're right, my favorite thing, 10-year Treasury yields. And so everyone says that lower interest rates lead to more economic growth. In fact, Fed Chair Powell said that today. Well, according to this chart, he's absolutely, completely wrong. And no, I am not cherry picking it. I just wanted to zoom in a bit so we could see it. But you can see when interest rates go down, GDP growth is either negative or flat. And when rates go up, GDP goes up, so on and so forth. And you can very clearly see it in this chart here. So as interest rates go down, GDP growth is going to head lower. And so the final print for the first quarter, whenever it does come out, will not be good. And probably the second quarter won't be good as long as interest rates stay lower. Well, you already know where GDP is headed. So let's move on to the Fed. And I can summarize real quick that the Fed did not do what the markets were hoping. Investors were actually hoping the Fed was going to take the funds rate negative. And why would you? Everyone's crammed back into stocks. There's no real need. Remember, the Fed's goal is not to keep stock prices up, but to make people think that it's okay to buy stocks because higher stock prices lead to more spending. You know, the Fed does not purchase any stocks. They do not own one share of anything. If they do own something, it is in the form of a loan, and we'll talk about that at some point. But let's take a look at what the Fed had to say, because from a macro standpoint, this just echoes what we've been talking about. And I want you to see it right in the minutes of the press release here. So they said weaker demand and significantly lower oil prices, keyword lower oil prices. So remember, if we've talked about how oil prices lead inflation lower, are holding down consumer price inflation. They're not just holding it down, it's going lower. That's how we know where consumer prices are headed, because oil is telling us that. The Fed just confirmed that. Now, let's forget about the rest of the stuff and dig into the implementation note. And they're going to keep the federal funds rate the same. So the market was a little bit disappointed, but you wouldn't notice that. And they said they're going to increase their purchase of Treasury securities, mortgage-backed securities, and commercial mortgage-backed securities in the amount needed to support the market. Now, Fed Chair Jerome Powell later said during his press conference that they did reduce the number, but they're prepared to effectively do what they need to do at any time. So we're kind of getting the picture that on a week-to-week basis, the Fed may make adjustments to this. They're still doing quite a bit. So the Fed is doing everything they can to support the markets. No surprise. They believe that deflation is going to be fixed somehow. They have a hunch that we're not going to experience it, and then at some point, all this liquidity is going to turn into growth when the economy can reopen. He did say that they were going to keep policies very easy. Interest rates would stay very low for much longer than people thought. And as a stock investor, that is the news that you always want to hear. Oh, low interest rates always mean stock prices go up. As a bond investor, you think low interest rates mean bond prices are going up. One of the two is wrong. And he said they're going to continue buying assets such as treasuries and mortgage-backed securities, as far as we can tell, for the foreseeable future until the economy recovers. Of course, he doesn't know. It's going to be a lot longer than he thinks, but that's what they're going to do. And this is great news because it just fuels right into my view. When the Fed eases, they create a deflationary shock. They can't avoid it. It's just what happens. We've seen the charts. We'll look at some more today as we get into your questions. But this is great news. And so when we look at what's going on between the stock market and the bond market, we have still this major disconnect. And so if we look at 10-year Treasury yields and let's overlay the S&P 500, we can see the S&P 500 is saying, look, inflation's coming. The bond market's saying, huh? What inflation? There's no inflation here. Inflation's coming. In fact, if we zoom out over a year, we see that the stocks are really out of line, maybe almost more so than they were before. And the bond market saying, look, in stock investors, there's no inflation coming. And if we zoom way out, and as you know, I like to kind of overlay the roughly 215 rally with bonds, so somewhere in here, you see this massive jaw that rapidly got closed. And now look, interest rates are still low and trending lower. Stock prices have rallied up. One of these two is wrong. The jaws have to close, and these jaws here are bigger than they were a year. They're bigger. And so that tells us that stocks are set up for a major deflationary move lower, or bond interest rates are set up for a major inflationary move higher. With the Fed easing, you already know what I think about that, and I think stock prices are headed much, much, much lower. Let's talk about the Nasdaq really quick, because right now everyone, I mean, if you want to be in the market, you might as well buy the Nasdaq. This is a tech-driven market, but people don't even know what they're buying. So I pulled up the QQQ, which is the largest Nasdaq 100 ETF. And I went to Morningstar.com, love Morningstar, under portfolio, and I scrolled down all the way to the bottom, and lo and behold, Microsoft, Apple, Amazon, Facebook, and two different share classes of Alphabet or Google make up over 44% of the index. If you tack on Intel and Pepsi, and maybe a little Cisco just because, half of the index is in 1, 2, 3, 4, 5, 6, 7, 8 stocks. 8 stocks make up the index. The last time that happened, you might be wondering, when we saw such crazy amount of consolidation in a small number of stocks, let's go to the QQQ, was back during the tech bubble when everyone was loaded into 5 stocks. So half the index, almost half the index right now is in 5 stocks. And what happens during a deflationary event where stock prices collapse, well, people end up selling, markets fall. And when you have a high concentration in a small number of stocks, you get an exaggerated move lower, because when everybody is selling, guess what they're selling? The same thing. And right now, what is everyone buying? The same thing. So the other day I got a call and someone said, I have some investments with someone else. I'd like to have some with you. Great. Why do you want to do that? Is something wrong with your other advisor? No, I'd like to be more diversified. And I kind of chuckled. I said, well, don't worry. Everybody pretty much owns the same thing right now. The Nasdaq, 45% of it's roughly 5 companies. 22% of the S&P is 5 companies. Doesn't matter where you're putting your money. If you're buying equities, you're buying the same thing. Now, the market completely does not buy the narrative of what's going on in stocks. And another way to look at it is crude oil. And we can see crude oil is not rising here. It's sitting, this is not showing the correct closing values. Closed up here about 15.5 a barrel. Doesn't really matter. That's bad news for the crude industry. Well, I got a call today from one of my friends, and he said that a helicopter flew over the Gulf of Mexico this morning, and the report came back that 93 tankers are parked off the Gulf of Mexico full of oil waiting to deliver. That does not show up in the weekly Department of Energy reports. Now let me tack on some information to that. There are 28 more ships coming to the Gulf of Mexico from Saudi Arabia with an estimated 43 million barrels of oil on them. Oil prices are headed lower, deflation is coming, and stock market cannot see it. It just cannot see it. It's pretty wild. All right, well, let's get to your questions, and then we'll come back and take a look at some of those charts that I might want to look at. And we got some great questions for you. Actually, you've got some great questions for me is actually how it goes. So the first two kind of go together. I've started to try to pair some of your questions together. So the first question is, can you speak to the shape of the bond rally you're expecting in terms of the peak to trough percentage move? It's too close to investment advice, so let's switch the question around. How low do I think yields are going? I think the 3-month yields are going to be back at 0, maybe slightly negative. I think 10-year Treasury yields are probably going negative, and I think 30-year yields are going to be darn close to 0. Now, do I think that's going to hit that all within the next 90 days? Could be a little later. The next 90 days, I think we get very, very close to those numbers to begin with. But in the end, I think the bottom of the interest rate market, wherever it usually is after the recession is over, we'll see almost negative yields across the curve. I don't think there's any demand there. Now, the second question from someone else that came in is, do you think it would be possible for us to see another yield curve inversion if it looks like the Fed might go into negative rates? Well, I don't know if the Fed's going to take the funds rate negative or not, but an inverted yield curve is when long-term rates are lower than short-term rates. Do I think that will happen again? Yes, I do. I will not be surprised if, say, 10-year yields are below 3-month yields. All right, next questions, these two kind of go together, so let me read both of them. Are the Feds actually able to buy assets or stocks? Can the Feds be the one propping up stocks? So the next question then you'll see kind of ties these two together. Thanks for answering my question, Steven. You're very welcome. Just one more if you do get the time. Of course, you've got it. In your videos, you state there won't be inflation because the money isn't getting loaned out by banks to the population. This is correct. Here's how the two come together. But since the Fed policy has now changed and they are purchasing stocks, is this not money now entering the markets? All right. So first off, the Federal Reserve Act has not changed. The Federal Reserve Act of 1937 is very clear about what the Fed can and can't do. They cannot buy stocks. This is very misleading. We have heard former Fed Chair Janet Yellen suggest that the Fed buys stocks. They can't. She knows it. They cannot buy stocks. So investors, for some reason, believe the Fed can, and they can't. So what the Fed can do is they can lend money out. And Fed Chair Powell was very clear about that today when he was asked in his interview about injecting money in the economy. He's like, look, I can only loan money out, and I only loan it to people I think are going to pay me back. And if they don't pay me back, the U.S. Treasury picks up the shortfall. So recently, of course, in the world of the coronavirus, everything seems pretty recent. What the Fed did is they thought the dollar liquidity problem was much worse than they really initially believed, and they figured out that banks did not want to give them Treasury securities for dollars. They wanted to hold Treasury securities. So the Fed instituted a stock loan program where, and I don't remember which companies that they would take, but there was a certain number of stocks the Fed would take on loan for dollars, but these were loans. The Fed was not buying the stocks. They were not making a market in the stocks. In fact, the Fed was very clear that at the end of the loan, which these loans were usually somewhere between 7 and 30 days to begin with, is you'll get the share of stock back, we'll get the dollars back, and whatever the value of the stock is trading at the time is what you get it back at. If it's higher, great. If it's lower, that's too bad. We are not making a market in it. So the Fed isn't buying stocks at all. Now there's some additional confusion about this since the Fed is buying high yield or junk bonds. Well, they're not really doing that either. So the way the Fed does this is they call special purpose vehicle, or as Steve calls it, a trash can. Because what do you put in a trash can? Yeah, stuff nobody really wants anyways. So the Fed creates a trash can called a special purpose vehicle. They put some money into it. Let's just say they put $1 billion in it. And then they say, we're going to buy junk bonds that nobody wants. So they'll go to, say, a company called BlackRock, who has a lot of experience in bonds, and says, hey, BlackRock, we'd like you to take this $1 billion and go buy some junk bonds. We'll give you some parameters of what you can do, and you've got $1 billion, and you can put that in the trash can. And the market gets like, oh my God, the Fed is buying bonds. Yeah, okay, whatever. No, the Fed is buying garbage and putting it in the trash can is what they're doing, okay? So they put the bonds in the trash can. And then they put the lid on it because it's what you do when you have a bunch of smelly bonds in there that no one wants to see, and you try to take it away from the market. Now, in the perfect world, the market eventually recovers, the lid comes off the can, and the bonds are sold back at the market at a higher value than what they were purchased, and then the profits are returned to the U.S. Treasury. That is in a perfect world. In an imperfect world, which probably will happen, is the bonds lose value. At some point, they're forced to get rid of these things anyways. I don't know what the time horizon is on it, but at some point, the Fed goes out and says, okay, hire someone, maybe BlackRock again. Time to sell the bonds, and now there's a loss. So maybe the $1 billion is now $750 million. Does the Fed eat the loss? No, they don't. The U.S. Treasury, U.S. taxpayers eat the loss. The Fed cannot lose money. So no, the Fed cannot buy stocks. They cannot buy other assets. They can put them in trash cans, and that's what they do. Okay, so let's see. Next question. Hey, hello. I am addicted to the video updates. It's pretty awesome. Look, we're all addicted to something, and if you're addicted to this, that's pretty cool. I don't see a correlation between IAU/GLD and GDX. Why is that? Is it like XOM and oil prices? All right, let me translate this question. What they're asking is, hey, gold prices are going up and gold miners aren't. Why is that? Is it kind of like the reason oil stocks are going up and oil isn't? Normally the way it works is you want to see the stock lead the actual commodity. So you want to see oil stocks rise ahead of crude oil. You want to see gold mining stocks rise ahead of gold. So that's what you're usually looking for. Now, right now we're seeing oil stocks lead oil prices, but oil prices aren't going up. What does that tell you? Where oil stocks are probably headed? Yeah, down. Now, right now, gold is in bullish mode, and mining stocks haven't been following it. What does that tell you? Where gold is probably headed? It's lower, because normally the mining stocks lead the metal, or in oil, usually the oil stocks lead crude. Well, that gives you some reference points to follow there. All right, next question. Really enjoying the videos and learning tons. Awesome, thanks. Glad you could be here. Glad you're learning something. What are the major macro indicators using on a day-to-day to read the market? Well, can you briefly explain them to me in one of your videos? All right, well, here's the deal. Look, I can't read the market any better than anyone else. There's a reason why the headline of this video is trying to make sense of markets that don't make any sense, because look, they don't. There's no way on a day-to-day you can look at the economic data and figure out where stock price is headed. So how do I look at the economic data? I look to validate my thesis. So if my thesis is interest rates are going lower, I'm looking at the economic data to see if, hey, whoops, the economic data is saying reflation, or is it saying deflation? Now, where do I go to do that? I go to investing.com, and under news, there's economic calendar, and you can look every day or by the week, and it tells you what's going on in the world. And so today I would look at mortgage applications to see what's going on with that. And then I say, oh, here's what's going on with GDP. That makes sense to me. Now here's crude oil inventories, and then the Fed rate decision. So what's coming up on deck tomorrow is, see, we're going to get core personal consumption expenditures. So that feeds into what's going on with the Fed's decision. So they already know that, but we'll learn that tomorrow. We're going to learn about initial jobless claims and some data on personal spending. So that's kind of where I go. And I use that again, obviously I can't predict where the markets are going, because if I did, I'd be really rich and I'd teach you how to do it. But I use that to figure out, is my thesis still correct? Okay, next up. Let's see how we're doing on time. All right. So you said that banks need to offer lower interest rates to get people to take out loans when money is tight. What do you mean by money is tight? And okay, so let me give you an example of what money is tight is. Let's pretend we're little kids and you hear the ice cream truck coming down the street, and it's a hot summer day and you really want some ice cream. And the best person to buy it for you would be your mom or your dad. So you go inside and you find mom or dad, whoever happens to be there, and you say, hey, mom, hey, dad, can I have some money for an ice cream? And when money is loose, mom or dad reaches in their pocket or says, hey, go and get on my dresser or my purse, wherever, and go get $1 or whatever it costs, go have some ice cream. There's no argument. There's no discussion. It's, hey, go ahead. That's money is loose. Money is tight as they say, well, son, in my case, son, yeah, no, you can't have any ice cream. And, you kind of whine at him and haw as kids do. And they said, look, no, I'm not doing it. So you go into your room and you dig through all of your change and you find out you have you have enough to buy the ice cream. And that's where you ponder, do I really want to spend all of my money on ice cream, or do I need this maybe in the future for something else? That is what money is tight, is when there isn't enough of it and you have to make a hard decision about it. I hope that kind of, using an analogy, makes sense. So why would demand for loans be less when money is tight? It's pretty simple. If there isn't a lot of money rolling around and I lend you money, what's the most important thing that I think about after I've lent you the money? Is you paying it back. And if money is tight and I'm concerned that you might not be able to get it, what am I concerned about? You not paying me back or defaulting on the loan. So interest rates tend to go down to attract high quality credit customers who have a very high probability of paying them back. Think of it this way. If you were going to lend me money, would you rather lend it to me at 1% or 10%? Well, I'd assume you'd want to lend it to me at 10%. Well, why is that? Because not only are you going to get more interest, but if I default on the loan, say whatever asset, is tied to that loan, not only are you making more money on interest, but you have a chance to recover the asset and sell it and perhaps get your money back. At 1%, if I default, you're losing money. That's tight money. So that's why when interest rates, or when money gets tight, interest rates go down to attract high quality credit customers. Now, it doesn't mean there isn't a long line of people that want to borrow money. It's the bankers saying, no. Oh, we'll take you. No. No. Oh, yeah, you over there. Come here. You got some money. We'll take you. That's how it works. So hopefully, so your last example made it really understand. Hopefully that makes sense to you. If not, send me another question. We'll keep working on it. What I meant was that my assumption is since most car loans are between 2 and 10 years long, auto loan rates are affected by both those treasury yields. Let me know if I'm wrong. Look, you're probably right. That would be my assumption. I just can't directly tie the two together. But yes, if treasury yields are down, interest rates on cars are going down. If treasury yields are up, car loan rates are going to go up. But exactly do they follow? I'm not really sure because, as I mentioned before, dealers and manufacturers can wrap costs into other things and hide that interest cost and do subsidize vehicles. So I don't know that it's perfectly correlated, but I'm sure there's a correlation there underneath somewhere. Next question, just to clarify, inflation equals a weaker dollar and deflation equals a stronger dollar, correct? Hey, when in doubt, let's look at a chart. So here is a chart of the trade-weighted U.S. dollar index against consumer price index. And yes, you see dollar going down. Generally, that means consumer prices rise. So you can see this is generally inversely correlated. And here we can see a rising dollar, falling consumer prices. In fact, we can even do one better. And we can invert it just to help really see how close the two are together. And yeah, you can see that that's a correct statement. I would definitely go by that. Following up on that is my view that the Fed's actions of monetary easing are very deflationary. So here we see the money multiplier. And I was going to show you this chart on Wednesday, but we'll do it today. Here's the money multiplier going down and the dollar rising, the dollar being in red. Here we see the money multiplier go down and people saying the dollar is going to go down. Yeah, I'm going to go with this happening here again. So that confirms my view and your question that yes, there's an inverse relationship with the two. Hence why we also know that consumer prices are going to head lower due to the Fed easing. All right, next question. We all know the Fed is on a massive bond buying spree, $41 billion today. That's now $18 billion because that's how far behind I am on questions. So we would imagine bond prices would rise. I agree with that. Yields should drop. We agree with that. Stocks fall. Yep. I'm 100% behind that. But for the first time in history, the Fed is also simultaneously injecting massive QE. That is what QE is. Quantitative easing is that. Is exactly the Fed buying bonds. That's what it is. So as we explained in Monday's video, the Fed is on average buying a 7-year maturity bond treasury note from a bank and swapping it with cash. That is QE. And if QE, see where we're going with this? So let me read the first part of the question again. So we would imagine bond prices would rise, yields would drop, and stock prices fall. That's correct. Yet everybody thinks QE causes stock prices to go up. Isn't that interesting? Doesn't work that way. What you have is chart crime. Here's the Fed's balance sheet in blue. Here's the Wilshire 5000 because Fed database doesn't have it going back that far. If stock prices truly indeed followed the Fed's balance sheet, then this rally in the 2000s shouldn't have happened. This big drop during the great financial crisis shouldn't happen because the Fed drove its balance sheet up, so that there's no correlation there. You see that these two kind of ran up together, but why is that? Because the Fed had lower rates and corporations were buying their shares back. Then if the Fed's balance sheet flattened out, why did stock prices keep going up? And the Fed's balance sheet went down, why didn't stock prices keep going down? And the Fed's balance sheet is now way at new all-time highs. So why aren't stocks way at new all-time highs? Now, these two are really not that correlated. What you see is people will do what I call a chart crime. They'll zoom this in to support their thesis of, oh, look, we can make this thing look. Look, how they go up together. Yeah, chart crime. Sorry. They're not that correlated. Let's go on with the rest of the question. This is the primary reason for the rapid stock appreciation. No, I disagree with that. I believe, why do people buy stocks? Why are computer programs buying stocks? Because they're going up. And computer programs chase computer programs higher. Investors are chasing the market up because they got out. When you have more people that are buying than selling, it's not because the Fed is not buying stocks. There's nowhere in that bond cash relationship that any stock is purchased. Now, if you told me that interest rates were low, I'll borrow money on margin and buy stocks, or a hedge fund's going to borrow money on margin and buy stocks. Yeah, okay, I get it. But that's not what the Fed is doing. That's what someone else is doing based on interest rates being lower. The Fed is not making a market in stocks, period. Also, you mentioned today the stocks and bonds are rising together, but it appears that high-yield bonds and ETFs like HYD and J&K are falling. Can you provide your thoughts on why this might be happening, and does it concern you as a bondholder? Well, no, because I'm not invested in junk bonds at all. Junk bonds follow stock prices, and let me show you that. So here is, where is it? HYG. And let's overlay the S&P, and let's zoom out. Well, maybe not necessarily so far, but here over a 2-year period, you can see the junk bonds and stock prices follow each other. When I refer to bonds, I refer to treasuries. So while we're in the charts, let's take a look at a few things. We saw the S&P go up, but what about interest rates? You'll notice that they're bouncing off this 1.2% floor, but interest rates need to be higher. Treasury yields need to be way up here somewhere to validate this move higher in stocks. And they're very range bound, so they're bouncing between this range. And right now, sellers are the ones that really need to drive, say, 30-year yields back up to 1.4. But they're not having much luck. If we look at TLT, as we get a little bit better data, we can see that every time this thing gets roughly over 1.2%, which is approximately where this purple line there is drawn, you see selling come in. So what happened in overnight trading and early trading? It creeped up there. Selling came in. Some buyers came in, and some selling in aftermarket trading. Then it's kind of bouncing back up a little bit. But what's nice is, despite all of this persistent selling, and you can go back the last 30 days where there's just selling, bond prices are holding up. They're saying there isn't any inflation coming. And at some point, these sellers are going to be exhausted, and they're not even selling on big volume. So it tells us the bond market is a sayer of truth here. There is no inflation. Crude oil prices are proving that. The consumer price index will validate it, and the Fed told you it's already there. So we'll be back Friday. We'll get to some more of your questions, take a look at the deep credit data. Again, as always, take a look at the market from a macro lens and see if we can make any sense of it. Perhaps maybe by then, maybe equities will start to reverse. Who knows? I'm Steven Van Metre. Thanks for being here with me. We'll see you on Friday. Bye now. The content of this video is provided as educational information only. Is not intended to provide investment or other advice. The material is not to be construed as a recommendation or solicitation by a selling security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre on personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.